ESG integration databases have become important tools for investors seeking to incorporate environmental, social, and governance considerations into investment decisions. These databases collect, organize, and analyze large amounts of ESG information from company disclosures, regulatory filings, news sources, industry reports, and third-party research providers. They support activities such as security selection, portfolio construction, risk management, engagement, and regulatory reporting. Although ESG databases improve efficiency and provide valuable insights, investors must recognize that they are analytical tools rather than definitive measures of sustainability performance. Understanding their limitations is essential because over-reliance on database outputs can lead to inaccurate conclusions, inconsistent assessments, and suboptimal investment decisions. One major limitation involves data quality and availability. ESG databases depend heavily on information disclosed by companies, governments, and other organizations. Disclosure practices vary significantly across industries, countries, and reporting frameworks, resulting in incomplete, inconsistent, or outdated information. Some companies provide detailed sustainability reporting, while others disclose only limited ESG data. Smaller firms and companies operating in emerging markets often provide less comprehensive information than large multinational corporations. As a result, ESG databases may contain gaps that reduce comparability and reliability. Investors using these databases must therefore evaluate data coverage and recognize that the absence of information does not necessarily indicate poor ESG performance. Another important constraint relates to methodological differences among ESG data providers. Each provider employs its own definitions, scoring systems, weighting approaches, materiality assessments, and analytical frameworks. Consequently, the same company may receive significantly different ESG ratings from different providers. Unlike traditional financial accounting standards, ESG measurement lacks complete global standardization. Providers may prioritize different sustainability issues, interpret disclosures differently, or use alternative assumptions when constructing ratings and assessments. These methodological variations can create confusion for investors and complicate efforts to compare companies consistently. Understanding the methodology underlying ESG data is therefore as important as understanding the reported results themselves. A further limitation is the challenge of measuring qualitative and intangible ESG factors. Many ESG issues, such as corporate culture, leadership quality, stakeholder trust, ethical conduct, innovation capability, and social impact, are difficult to quantify objectively. Databases often rely on proxies, indicators, or scoring systems that may not fully capture the complexity of these factors. Reducing multifaceted ESG issues to numerical ratings can oversimplify important information and obscure critical context. While quantitative metrics support comparability and large-scale analysis, they may fail to reflect company-specific circumstances or emerging risks that require qualitative judgment and deeper investigation by investors and analysts. ESG databases also face challenges related to timeliness and forward-looking analysis. Much of the information used in ESG assessments is historical and based on previously reported data. However, many ESG risks and opportunities evolve rapidly and may not be fully reflected in current disclosures. Climate transition risks, regulatory developments, technological innovation, social expectations, and governance controversies can emerge quickly and materially affect company performance. Databases may not immediately capture these changes, creating a lag between real-world developments and ESG assessments. Investors must therefore supplement database information with ongoing research, engagement activities, market intelligence, and forward-looking analysis to identify emerging sustainability trends. Finally, ESG integration databases cannot replace professional judgment and comprehensive investment analysis. While they provide valuable information, they are only one component of a broader ESG integration process. Data limitations, inconsistent methodologies, disclosure gaps, subjective assessments, and rapidly changing sustainability conditions all constrain the reliability of database outputs. Effective investors use ESG databases as starting points for deeper research rather than as definitive investment guides. Combining database insights with qualitative analysis, company engagement, financial modeling, industry expertise, and materiality assessments allows investors to develop a more balanced understanding of ESG risks and opportunities. This integrated approach improves decision-making and supports more effective sustainable investment practices.